Hello again and welcome back. You'll remember that in Lesson 1, we introduced you to financial accounting, which is designed to provide information that's useful to the providers of capital to businesses, primarily investors and creditors. And generally accepted accounting principles, the rules that govern the kind of information that is to be provided to investors and creditors, requires that that information be presented through what we call general purpose financial statements. And we previously identified the three basic general purpose financial statements. Let's review them again briefly. First, there's a balance sheet, sometimes referred to as a statement of financial position. The purpose of this financial statement, the balance sheet, is to reflect the resources of a business and explain how those resources have been provided or capitalized. Have they been provided by creditors or by investors or owners? The second required financial statement is referred to as the income statement, or sometimes the statement of operations, statement of earnings, statement of profit and loss, or even P&L statement are terms that are used to describe this particular financial statement. This financial statement, the income statement, seeks to represent the results of operations to show whether or not the business has made a profit. Are we really making money in the business as we provide goods and services to the customers? The final financial statement that's required is a statement of cash flows. The statement of cash flows is designed to identify and distinguish the major sources and uses of cash during a period. Cash is a critical asset or resource of a business, and so it's helpful and to identify, in fact, the major sources and uses of cash during a period for the business. An additional optional financial statement is not really required under generally accepted accounting principles, but is typically provided when you look at an annual report. This is referred to as a statement of retained earnings or a statement of owner's equity, or maybe even as a statement of changes in retained earnings or owner's equity. And again, we will discuss this a little bit later in this lesson and really won't focus on it at this point in time. In addition to these general purpose financial statements, generally accepted accounting principles also require supplemental and explanatory footnotes to the financial statements in order to provide some additional information to the statement users to help them understand the information that's contained in the general purpose financial statements. Well, let's go ahead and start focusing on these basic financial statements. And probably the best way to do it is take each statement one at a time and then identify each of the basic elements in those financial statements and the different kinds of information that's presented therein. And so let's begin today by studying and looking at first the balance sheet. The balance sheet embodies what we refer to as the basic accounting equation. And here it is. Assets equals liabilities plus owner's equity. To some extent, we've already really discussed this basic accounting equation. We've said that the business resources, and really that's what the assets of a business are the resources, the capital of a business, are provided one of two ways. We either get our business resources from creditors, or we borrow them, or we get them from owners of the business or investors. So the amount of business resources or assets will equal the amount that we've received from creditors or from owners. In fact, let's assume for a moment that we have total assets of $100,000. Now, there may be a variety of different assets, but the total amount equals $100,000 worth of assets. If, in fact, we had borrowed $60,000 worth of those assets, and we'll refer to those as our liabilities or obligations to repay, then the remaining $40,000 must have come from owners. We'll refer to that as owner's equity. Now, let's look at each of these elements of the basic accounting equation, which is really the balance sheet, in a little bit more detail and try and define these elements a little bit more precisely. For example, let's look at assets. I'm going to define assets very carefully as resources, but I'm going to add to resources some description of what I really mean. Resources are property or rights that are owned or controlled by a company and provide probable future economic benefit. Now, as far as future exams are concerned, you're probably wondering, gee, am I going to have to memorize this thing or what? Frankly, it's not critical that you memorize it, but you do need to understand it well enough to be able to identify assets and then to use at least the key elements of this definition. In fact, if I were to pick out the key words in this definition, I would probably say that assets are property or rights that provide probable future benefits. Those are the key words. Some of the most common assets are cash. Some people actually think of cash as being, property because you can touch and feel it. But really, to some extent, I think cash is probably more like a right. It gives you the right to buy certain things if you choose to. But whether it's a property or a right really makes no difference because both property and rights are assets that have, as long as they have some probable future benefit. And certainly cash does. Everybody'd like to have a little cash in their pocket because it allows them to buy other things if they desire. Another common and important asset to businesses is referred to as inventory. Again, we're introducing you to new business language and terminology. What is inventory? Inventory is merchandise that's been purchased and is currently held for resale. If you were to go down here to Walmart and do some shopping, all of that merchandise, those goods that are on the shelves there, that's all Walmart's inventory. It's merchandise that they have purchased and they're holding for resale. If you were to go into business and let's imagine that maybe, you're thinking about opening a store and you're really good at computers. And so what you're going to do is you'd like to be a computer merchandiser. You want to buy computer hardware, PCs and printers and various other items and maybe even software and sell that to the public. And you think you could really do a good job because you're really familiar with, high technology merchandise. This would be inventory to your business. But let me ask you a question. Let's assume that some of that inventory, maybe some software programs or something, they're kind of sitting around and nobody seems to purchase it and it sits there for a couple of years and you know as well as I do that in high-tech products that some of that inventory can basically become obsolete, or this merchandise can be become obsolete very quickly. And it's possible that you may have some stuff sitting there on the shelves that you purchased a few years ago that now maybe you can't even sell. Would that really be an asset? I mean, inventory that was kind of technically obsolete? Well, it's property, but does it have any probable future benefit? If in fact you're never going to be able to sell it, theoretically, even though you've got merchandise there, it's really not an asset and therefore shouldn't be included on the balance sheet. Let's assume that you do buy some computer equipment and instead of putting it on your shelves for resale, you're actually going to use some of that computer equipment to handle your own accounting. Would that be inventory? Well, by definition, it would not because you're not holding it for resale. It may be just like the inventory on the shelves, but since you're not holding it for resale, we typically wouldn't call that inventory. But is it really an asset then? Well, if in fact you're going to be using that equipment to help administer and operate your business, it seems to me that it's going to be providing some probable future benefit to you, because it helps you administer and run the business. This should be an asset, this computer that you're purchasing to handle your accounting, but we would probably describe it as simply equipment, or computer equipment, or office equipment, or something like that that accurately describes it, and it theoretically would be an asset as long as in fact it is going to provide some probable benefit to us in the future in operating our business. Another common asset is referred to as accounts receivable. Accounts receivable are amounts receivable from customers due to sales made on account. In some cases, we'll have customers who are interested in buying our goods or services, but they can't pay for it right now. And so what we may do is actually go ahead and sell them the goods and the merchandise, but enter into an arrangement with them where they're promising to pay it to us within, for example, 30 days. Is there any asset associated with this transaction? I mean, do we now have any kind of property or rights that have probable future benefit when we make a sale on account? And the answer is yes. I mean, in this particular case, you don't have something that's tangible that you can touch or feel. But what you really own as a result of this transaction is the right to receive cash in the future from this customer. Well, an asset is property or rights that have probable future benefit. If in fact you have a customer that in fact is going to pay you in the future, there is going to be benefit because you will receive cash, and then you'll be able to use that cash to continue to grow your business and do the things that you need to operate it. And so an account receivable, as long as in fact it really is collectible, would be an asset under the definition of a right having probable future benefit. But if in fact you have made a sale to a customer and have a promise to receive cash, but that customer has kind of bailed out or filed bankruptcy or gone to the Bahamas and never plans to pay you again, you may have a right to receive cash, but, is there really any probable future benefit if in fact they are never going to pay you? In that case, that account receivable would not be properly included as an asset on your balance sheet. Some other common assets that you might see on the financial statements, the balance sheet, statement of financial position, might be office supplies. And again, office supplies aren't something that you're going to resell. This is paper products and envelopes and stationery and other things that you use in the administration of your business. But as long as in fact you have those supplies and they are going to assist you in operating your business, it provides some future benefit to you. Land and buildings would be assets typically. Unless, I suppose, the land and the building are sitting on some kind of a toxic waste dump, and as a result can never be used, and in fact, the whole area's been quarantined off. In that particular case, you may have land and building, but is it really an asset to the business? If you're not going to be able to use it in any productive way, in fact, in this particular case, maybe that's actually a liability. People are going to sue you for infecting their lives or something like that. But if in fact there is no probable future benefit, even though you've got something that's tangible like land or building, it would not be reflected as an asset. One final common asset that you might find on some businesses is an asset like patent. Again, patent is one of these things that, again, you don't really touch or feel. It's not like building or equipment or tools or things like this. It's really kind of an intangible asset. Patent really represents a right. It is a right issued by the government to use a certain technology, an invention or discovery in an exclusive way in the manufacture or production of goods or services. Would that be an asset? Well, it would be an asset if in fact it had the discovery or invention really truly did have some value in terms of providing goods and services that customers really want. If you had a patent on some cure for cancer, you'd have a heck of an asset. And even though it's not property, because it is a right that has probable future benefit, it should be reflected as an asset on your balance sheet.